very good evening to all our viewers this morning. I would like to thank you all for logging in today uh, to be a part of this webinar. Here I have with me uh, a very experienced financial banking professional, Ashwini. She's a very good friend of mine, and she took up this time to give us some more information about stock trading and how to manage money and other factors in the stock market. So she has a background in MBA and she's a banker by profession. And today we will be having a great opportunity to discuss with her ideas, her perspectives, and her thought process about the stock market, how she's been going about it for the last many months or years that we know about her. So Ashwini, thank you very much for being here today on this webinar. And we are really glad to have you here and sharing your insights on the stock market. And we would love to have more information from you about the stock market. So welcome, and please, we would love to hear from you. Go
Thank
ahead.
you, Rizwan. That was like absolutely great for a Saturday to begin. Thank you for the introduction. Overwhelming.
So we would love to hear all about the trading and stock market if you could share it with us.
So it is very funny. I'm a very voracious reader, I think thanks to my father. And I was reading this book, which is called as The Rich Dad, Poor Dad. And it's a very famous book. So in that, it was very clearly said that, your what you need to really start working on is your secondary source of income. And that I think, hit really, really hard. And, as a working professional, how do you maintain two careers? That's really not possible. So, but there also needed to be a secondary or a third source of income that needs to come in. And then stock market came across. I started understanding that these are things, or these are activities that may not take a lot of your time, but needs a lot of thorough study and dedication. So I think I bought my first stock, if I have to say, or my first demat account was, I think, somewhere opened in 2010 with one of the leading brokers. And I think that's when I had started trading first. I think I do not want to quote the stock, but yeah, that's when I pulled out my first stock. I made my first login. I made my first transaction, if I had to say. And I still remember the day when I was trading at that point of time and not investing. So I would put in the order and I would be clinged onto my screen and I would see how the price fluctuates. So every time, the price would go up and I would feel happy about it. And every time I think, the price fell and, my heart rate literally fell faster than that. So I think, trading had a lot of dopamine that actually love could do to me. So I sticked around with it. And there are very clear goals that are there. There are very defined purposes that are there to be into the stock market. And yeah, I think that's how it began.
So, you recommend that people should not be sitting across the screen and watching the graph going up and down. That's what you mean to say, that once you are in the trading industry, you need to be disciplined, not to be totally focused on the moving graph throughout the day, and have the discipline to move out of it and have an automated control over it. Is that what you mean?
Rizwan, I have a very delicate heart, so I cannot take that pressure. People who are, who can really take that pressure, I think, kudos to them. But on a very serious note, it'll be very impractical for somebody to sit through the 6 hours of trading, session from Monday to Friday. I'm sure that's going to be a task for them. So, and looking at the ticker and not letting your emotion flow in, I think is another level of meditation, if I would have to say. But I am somebody with a faint heart, so I can't take those sticker prizes.
So you would recommend people to be more on not on a day trader process, but maybe long terms and weekly charts and monthly chart. Would that be a better idea?
So I will probably want to touch base on two things here. One is, when you make an investment, there are two very major things that you need to keep in mind. One, what is your risk appetite, or what are your financial obligations? So when you talk about risk appetite, that can I how much percentage of money that I can lose out of my capital? For example, if my capital that I'm investing is 100 rupees and I'm okay to take a 10% loss. So which means even if my capital goes 90 rupees, I'm absolutely fine because that is not going to change my lifestyle. So that is one. How much, what are you as a person? What is your risk appetite? Are you a very aggressive person? Are you a very conservative person? So these are things that you need to kind of, identify. That's one. Second, you need to understand that, what is the horizon that you're looking at? Are you looking at immediate profits? Are you looking at building a portfolio, or are you looking at like a short term, medium term, long term kind of a goal? So I think these two things, when an individual answers, after the individual has answered this, then the realization comes that, do I become a trader or do I become an investor? And a lot of people interchangeably use these words, but very clearly defined two different segments that these are. So when I talk about a trader, now for example, if I decided to become a trader today, I will pick up X stock. I will define that I just need to make 5% on this particular stock, and I will sell it off at that point of time. Now, a trader could be a day trader, which is called as an intraday trade, or it could be a swing trader, which means I buy, I hold it for a certain duration of time, say for a week, or for 15 days or for a month, and then I sell it off the moment I'm making that 5%. Now, these are the kind of traders that are there, and there are also somebody called as the gap traders. So which is more technical, but just as an FYI, there are something called as gap traders also. So these traders will only trade between the gaps of open and close of markets. So these are the type of traders that are there. But when you talk about investor, so my transition has been from a trader to an investor. Now, as a personal agenda, I would want to build a portfolio of, at least a crore, into my equity. Now, this is about building a portfolio. When you build a portfolio, you need to understand that, what is the horizon that I should build my portfolio in? Because when I talk about an investor, the immediate question that you need to answer is, what is my horizon? So there is a very clear difference between a trader and an investor. A trader is talking about returns, profitability, and an investor is talking about building an entire portfolio. So these are the two.
Yeah, the question again arises, Ashwini, is if I'm an investor, okay, I put in X amount on a share today, but within the next 2 or 3 months, I see that the market has gone up and I'm making substantial profits in that particular trade. So you still think that I should hold it for 3, 4 years? Because if I'm making, say, 30% on it, would you advise me to get out of it now, and as it goes down again enter the market? Would that be a better strategy than holding a good share for maybe 4, 5, 6 years uh, on a long term, when the graph itself is going to be moving up and down throughout that 5 years? So what would be a more intelligent way of doing it? Rather lock in for 5 years, or keep watching the graph for months and sell on peaks and buy on downturn? What do you think?
So, I mean, this is a very prominent question that keeps coming in, and I think buying low and selling high has been a strategy that is throughout. In terms of either an investor or an equity trader. But again, if you come back to the question, for example, if you bought something at 100 and you have made up your mind that I would want to hold this. Probably, so there are two things that you actually evaluate something on. There are technical factors and there are fundamental factors. Now, for example, if you buy a legacy stock, when I say a legacy stock, it is like, the company has been there for, 25 years, 30 years, 40 years, okay? And you know that, your agenda would be to draw out dividends probably from that particular stock. So in that kind of a scenario, you would want to hold that stock for a longer duration of time. Again, I'm coming back to the perception. What is the perception that you would want to do? Do you want to earn dividends out of it, or you've seen it has made 30-40%? And in the past 3-4 months, if you actually go back, there are a lot of stocks who have actually performed more than 50%, because from the 23rd of March, or from the last week of March, first week of April, from 7,500, markets are at 11,500 now. So that moment, any stock that you would have invested at that duration has given you this kind of return. So you are bound to be tempted to kind of, sell and then, reposition yourself. Now, if you see a better opportunity as a disciplined investor, you would want to kind of, square up this position and then reallocate, that to a different position. That is also one of the strategy that you could use. So again, coming back just to add on, technical analysis, fundamental analysis. These are two things, or these are two studies that you kind of, get into before you decide, or before you actually make a decision. Like you mentioned that, what if I know that, it has already done the rally and, the price has reached its maximum? Yeah, it is obvious, it is right to, sell off your position there and then, search for another stock which is yet to do the rally, which is a very fair ask. But are your technical studies supporting that decision of yours is something that I think needs to be kept in mind. I hope I've answered the question.
No, I do totally agree with you, but I have heard about a lot of investors or market professionals who are saying that the blue chips or the good returns or strong companies don't give you that kind of returns which new companies with strong fundamentals do. So from that perspective, I wanted to know if I, because there's a lot of research going on that they say 5 or 6 years holding a blue chip, it basically averages off to 15, 20, 25%, right? In a 5 year span. But in the same scenario, if I have a strategic plan of monthly or 6 monthly analysis of that particular stock and keep myself, buoyant, like selling, buying at dips and again selling, would that the sum of all that not be much better than a 25% rise in 5 years? Would that not be a good idea?
That definitely will be. I would rather draw an analogy to what you're saying. The number of photographs that you'll have on your phone if you travel every month is going to be much more higher than you travel every 2 years or every 1 year. So you're going to build up memories at the end of the day. So the more you put in time, I'm not kind of, guaranteeing that the returns are going to be more, but you're going to be very sound in your subject. You're going to keep buying and selling. So your returns are definitely going to be higher. So depending upon how much feasibility that you have, how much subject knowledge are you gaining, how much spare time and capital you have. So depending upon all these factors, if I have to say, if you want to go as a rebalancer every month, then of course you are definitely going to make more returns. Reason being because you are investing not just your money but your time into it, and the time will eventually pay back. Because if you've sat through and studied for the entire 12 months versus that you're reviewing only in the March kind of a period, your knowledge about it, or your understanding about the momentum of the market is 12 times higher. It's there is a very clear difference between probably reading an article or reading your economic times versus actually logging in and tracking a chart. You can very well see the difference that when I see, okay, these are the top performing funds, but when you actually start going and checking these trends, checking
The
the
trend.
news behind it and everything, it's very evident.
And again, Ashwini, another thing, we are not going to be sitting there every day or every week. It could be once a month or once in 2 months or quarterly, something like that, which does not really take much of your time. You can just keep a watch on the graph or the trend and take a decision monthly or quarterly going forward. That could be a better way because correct me if I'm wrong. they say that the times of the blue chips or the trendsetters is no more, because the margins of returns on blue chip stocks are not as they used to be maybe 10, 15, 20 years down the line. Is that true?
So just to probably kind of initiate a thought. So if there is a boat and if there is a cargo ship, if I have to dismantle a boat versus a cargo ship, what do you think will take the maximum time? Obviously the ship. Obviously the ship. Okay. Now these companies that you're talking about are these amazingly huge companies, established companies. For them to run out of business, for them to run out of customers, or for them to run out of the entire technology bit of it, is going to be very very kind of alarming if they do not,
Unlikely, yeah.
yeah, if they do not change with the coming era and the coming technology. Yes, they will fade out, and we've seen in the past that companies have absolutely gone bonkers, but they are too big to fail, to be very honest. Yeah, and that is when when you see, and that is when I am coming back. So if there is a Nifty 50 stock, or if there is a Nifty 100 stock, there is a reason that it is representing that index. There is a reason that it is representing the entire structuring, or or even being a part of that index. So I think some confidence on the fundamentals need to be given. But then nothing is certain. No company is certain. We have seen cases in the past about the companies bit of it, and the scams that happen. But nothing can substitute your study bit of it.
So, you recommend that if someone wants to be trading in stocks, he needs to do an in-depth study and keep a watch and keep learning as much as he can about the stocks and new trends and new market entrants, so that they exactly know what they're doing, rather than just putting bets on something which they hear in the newspaper or read on the news or something like that.
So there are two things that I would want to kind of pinpoint here. So when you decide that, okay, I would want to start trading, or I would want to start investing, please decide on the commodity that you would want to pick up on. Now, even within equity, or for example, in the secondary market, do you want to stick to equity? Do you want to get into foreign exchange, which is Forex? Do you want to get into futures and options? Or do you want to get into commodity? So these are the kind of questions that you need to decide. Okay, I have decided that I would want to get into equity. Now, understanding a point that that you would want to get into equity now, what is it that I would want to kind of do? That I want to become a day trader. Getting my point? So when you say that, okay, I want to become a day trader, this is the capital invested, and this is what I'm supposed to be doing, or these are the horizons I'm supposed to be achieving. Going back to the study bit of it, or going back to the knowing bit of it, this is like in a very dynamic kind of subject. You cannot be left out, not reading, not knowing, not getting to hear the news. You will be out and out. Like if you've defined equity, like we have had a very recent IPO, and if you're not reading about it, or if you're not kind of diversing what is an IPO into, you're not going to make the returns. So I think there's absolutely no way that you can just come in, make money and go out. I think market will make money out of you than you making money out of market.
Yeah, because you're right. Getting into the markets without knowing what you're getting into would be not a very intelligent thing to do. So, coming to that question, which I've always wanted to ask you, Ashwini, what is the process of learning the market? Just if you could give a few steps to the viewers as to what would be a good idea to get well versed with the market, so that they can independently do their own trading.
So I think when it comes to self-study, the very first thing a person has to do is understand the difference between what's a trading account versus a demat account, and the different types of account. I think the very first understanding of these type of accounts need to be there, and then you could do it through any of your what do you say, any of your, for example, if you're with X bank, the X bank will give you a trading and a demat account. So get to know what's the difference between a trading and demat account. So trading account is where you do your actual execution, and demat account is where your actual shares start reflecting. So this is a very basic difference.
So there are
Getting back now,
two accounts that you maintain basically.
yeah. So a trading account is basically that I do my buying and selling only to
Mm.
this particular account. But
Mm.
when I say a demat account is like probably my bookkeeping account. So it reflects all the shares that I have been holding, my buying and selling. So that's like a statement. So this is a basic difference between a demat and trading account. Second, I think a beginner should start focusing on is the terminologies. So when I say ask price, bid price, when I talk about margins and stop losses, so these are things that are very commonly used. So for example, if I have to say, what is a stop loss? If you go by the verbatim word of it, stopping your loss is called as a stop loss. So you need to know that, what are the ratios to put across in a stop loss. So probably, this level 2 would be getting to know the terminologies. I think level 3 of studying would be, do I pick up, what are the kind of technicals do I start studying on? Or, how do I read a chart? Or how do I, because it's all about numbers. So, if I have to pick up like, indicators. So if in technicals, if I have to study about indicators and trends, so what are these trends? What are the indicators? So I think level 1 would be understanding the accounts. Level 2 would be understanding the terminology. Level 3 would be understanding your technicals or fundamentals that are there. And when the person reaches there, I think at the fourth stage where he's actually executing, getting to know that how the entire platform works, I think he's well versed.
So
That will be.
that is a very good question that I want to ask from my end, because I read a lot about the stock market. I get an in-depth knowledge, but the courage to actually go and invest on your own, and that transition is the biggest hurdle. I'm sure many of my viewers also might agree with it, because they feel, how do I go about it? There should be some guidance. Or what would be your idea? How can a person start live trading safely without having the jitters, or that anxiety that comes in when he's starting off, because he doesn't know what he's reading. The graphs are so complex. There are so many figures and graphs going around on the screen. So, how would you recommend the viewers can get over this transition so that they can get confidence and then start on their own? Is there a strategy or an idea you can recommend them?
So there are a lot of these providers who give you demo accounts, and you can create a demo account. There are a lot of you Google, and you will have a lot of demo accounts that come in. So the demo account will give you a live experience about, okay, how much do I put in? How much? What is my stop loss? What is the quantity that I'm comfortable in? So these are the kind of things that a demo account will actually help you to get that little fear of executing a trade, squaring off a position. So that can actually work out wonders for you. I think, and like if I go back to where I was saying that if you need to decide what is the capital erosion that you can take, I have invested 100 rupees today. I can take up a loss up till 10 rupees. That is when I am comfortable losing out that money. And I think, when mentally you are prepared that, 10 rupees invested is probably for, an investment into my own studies into stock markets. So, might as well, I think that itself. So I think it's more to do with the mindset. And as humans, we are not prone to take losses. But, I think the entire business works on, a 1:2 ratio. So I know I need to see, or 1:3 ratio for that matter. I need to see at least 3 times the profit to, kind of, get into something. But that does not mitigate or, eradicate your loss at all. Losses will happen. If you put in, your 4 trades, one trade will of course go wrong, and that of course is your loss. So I think it'll be very hard to say that you get into investment, and then if you get into trading, you're not going to make loss. I think I have not come across anybody who's assured and guaranteed something like that, like 100%. I think the maximum I have seen is 85%. So which still leaves us with a 15%, scope for them also faltering. and these are very established companies. So if they cannot guarantee, and I think it's good to fail. You learn, you
Yeah.
be more cautious. Yeah.
Again, what you really said here is that there are two factors. One is the emotion management, and one is the money management that they call it, right? Because
Yes.
unless you have a strong control of your emotions and have a disciplined focus as to today I'm going to only invest this amount of money, and anything above that is a no, it's a lockout. Basically, you just take care that you do not go overboard and put in more money than what you have actually allocated. As you said, money management also needs to have a discipline, having a specific fund only for trading rather than keeping your bank account open to any kind of trades, which basically is a risky bet, isn't it? What would you say that?
It certainly is, and like I quoted, earlier, if you step in today unprepared, this is like a battlefield. You just cannot, be unprepared and not expect to be slaughtered, because you think of starting today, but there are already people who have started, decades and decades ago. So their experience and their knowledge and their technology, and a retail person cannot really have competition to. So you need to really define that, okay, this is my strategy and this is what, and like you rightly pinpointed, um, being a finance professional, I have learned it myself and I have burnt my fingers too. Nothing beyond discipline can really work in this kind of a setup. And you need to really do, you really need to do your paperwork. It's said that, everything in this world is created twice. So even in your trades, you really need to have a mental preparation. This is the stock I'm investing into. This is the amount. This is the return that I am wanting or focusing upon. And then when that is done, there's nothing to bother. If I had to spill out my strategy, that one of the strategies that I use, uh, irrelevant of whatever the fund is doing, I take up a stock. If I'm making 5% on it, I will exit, because it's a very clear discipline. So this is how I do my swing trades, because then your mind, it's not very occupied, that, and I would in fact, to connect to me better. So Monday, if you log into a trading session and sit from 9:30 to 3:30, you will really understand the kind of emotions that you go through. And it is a lot of pressure. So
Why do
just
you
to
say
avoid that,
Monday? Why do you say Monday? That's the opening day of
so
the month.
Mondays and Fridays are actually the most
Okay.
looked after, days, and they're very critical days. I mean, there are other critical days also, but then Monday is the day.
That's
So, and
good
for
money
example,
to be
any day,
made and good money to be lost.
both, both, absolutely both.
Now, you told me about this 5% strategy. Let me ask you one thing. Okay, you pull out after 5% profit, okay, but then the stock keeps on going 10%, 15%, 25%, 30%. How do you feel at that moment?
Let me quote you a live example. I had bought a stock at 185 rupees. Okay. I had bought a stock at 185 rupees, and I sold the stock at 200 rupees.
Okay.
200, 210 rupees, probably something around that point. I really cannot recollect. As of today, the stock is trading at 300 rupees.
Wow.
In the duration of one and a half, 2 months, it is actually trading at 300 rupees as we speak. Now, it is purely a mindset that do I go back, keep looking at that stock every now and then and say that, Ari, yaar, I should have done this. I should have not, squared it off. It's almost making, approaching double the amount that is going to be there. Or I make my 5%. I've made my profits at that point of time. I've reinvested my profits already. And then, my other funds are performing.
So
It's
you don't take it,
purely
you don't
from.
take it emotionally, basically. That's what you do.
No, I really cannot. So when I'm talking about building, a portfolio, you really need to, be very, very disciplined about how you would want to build that portfolio. I cannot build my portfolio with emotions. I'll have to build my portfolio with numbers. So when I backtrack, I know, and like another strategy that people use is that, can there be a strategy, or can I come to a break-even point that only my profits remain in the market? Like, I'll quote you another example. I have another pharma stock, if I have to kind of categorically speak. This pharma stock was bought somewhere in the month of April, and you know how pharma stocks have performed. Now that pharma stock is actually made its 100%. But I don't look at it. Reason being that when it made the money, what remains is there is just my profits. I've pulled out my capital. I've had a very clear calculation is at what percentage or at what price will I
You've
be able to stop
consolidated
out
the
the
share,
loss?
the stock. You have already taken your
Entire
investment out,
only
and
my profit.
everything is profit now.
Everything is profits. So when you
So
do that, when this is your profits making profits.
So
So
is
you're
that
speaking to
is that
zero.
the most important strategy that people should understand, that when they put some money, their first objective is to get back their investment, and then whatever stays there is only going to be profit going forward. Is that how you would look at any investment or a stock investment?
This
Consolidating
is
before
one of
anything
the
is.
this is one of the strategies. Like for example, when I bought, it was 50 stocks that I had bought. But when I consolidated in everything, when my profits remain in there, those are only 20 stocks that I hold as of today. So, if I have to say that, my 50 stocks versus my 20 stocks, of course, the returns are going to be very, very different.
Right.
So I think this is one of the strategy that you need to decide. So you really need to come to, I think, consensus with yourself that, okay, this is what I'm comfortable in. And I think, way before this, your mental preparation, if that goes, and I'm reiterating this is because, I have made my losses, and I have, I have known, how do you handle with those minimum capital, and you are bound to make that losses.
So,
And in every way, people lose money. And I think that generation then never comes back.
okay, so that basically pulls them out of the market with burnt fingers. Basically, they do not want to venture back. So it's better to come in safe, have an allocation, and invest small, basically, before you actually go big. So it's by testing yourself and the market that you need to uh, be able to sustain in the market. Am I right?
I think, it is also, a peace of mind for us that, okay, if I have failed, I should know the exact reason of why I have failed.
Analysis.
I lost 100 rupees that I invested, but I am absolutely clueless about what happened. Now that's a very sad feeling. But if I have lost that 100 rupees, if I'm able to at least rationalize that why have I lost that 100 rupees? Is it the company? Is it the timing? Is it the allocation type? What went wrong, or is it my study that went wrong? So at least I'm able to I'm prepared. I'm better prepared the next time. Because if I don't have a rationale for why I have lost, I will never be prepared. And I will actually end up assuming that what, I think this subject is not for me.
Uh, Another question. There are some people in the market who say you need to keep two types of trading strategies. One is your day trade, okay, or swing trades, short-term trades, and the same amount which you make from those trades, you put it into a long-term investments, like which go on for 6, 7, 10 years. Is that a better way of doing it, or do you think we need to stay in the short terms and keep making money on that?
So like I mentioned, so this is one of the strategy that will be in terms of like your profits remain in the market. So when when I made money, when I made my 5% from the swing trade, I would want to, I should be disciplined enough to reinvest that 5% into a long-term stock. And so when I do that, my profits are reinvested.
So that's the good strategy to go ahead with, right?
It is one of the strategies that you could use.
So another thing that I would like to ask Ashwini is that people, how do they develop their discipline? Can you give them some tips on how to develop their discipline in the market? Now, for example, everyone has a different budget allocation, right? So, say for example, someone has 1 lakh. What part of that has to go into his trading account, and how does he maintain?
But 15 to 20% maximum gets into equity. If he's a very conservative investor, he needs to get into something called as a debt instrument, okay, or like a fixed income kind of an instrument. Whereas depending upon if he's a very very aggressive kind of an investor, that can go up to 30, 40% also. So depending upon, again, reiterating.
What would you think is the a very conservative amount to come into the market with to be able to learn the market? Like I know that some people say 1 lakh is a very small amount, uh, but then what would be a good fund that will ensure that I have a reasonable amount of returns in the short term? What would you think would be a good figure?
Again, two very open-ended question. When I say return, what percentage are you? There's something called as a reverse calculation or a back calculation. So today, when you decide that X is going to be my retirement amount that I would be needing, there's a back calculation to it.
Okay.
You'll say that okay, how do you derive at that amount? My number of years, my salary,
You
my
have to do a
liability.
reverse engineering from your long-term goals to your day-to-day process. Is that what you're saying, right?
I mean, isn't that the most ideal way?
Yes.
I say that
But then
I need to
how did you learn that? How did you learn that? What is that? What is that process basically?
So I in fact picked it up from my insurance experience, if I have to say, because this is how the insurance industry works on, or this is how the retirement plans, not the insurance bit, but these are how retirement plans work on. I need to know that I am going to retire at 60. So when I'm going to retire at 60, the year is going to be so much. The inflation rate is expected to be so much. As of today, my number of working years are so much, and my number of dependents are. When all these factors are put together, you will be in a position to derive at that particular amount. That what, if I'm able to make this particular amount, I'm okay to have a retirement. So at least there is some figure or some goal that you are working towards. Otherwise, for example, you decide today that I think 10 lakh is a decent retirement amount for me. But by the time 20 years, 30 years down the line, when you reach that, and then you realize, yeah, 10 lakh is
Inflation
equal to
eats
1
through
lakh as of today. How do
So
you go
because
about it? What are you going to do about it?
so that brings me back to a very very critical question. FDs. When people put their FDs for 10 years or 15 years, don't you think they are doing the same thing?
See, I have remembered an era where FDs were double digit. I mean, I had an account in Canara Bank, and I had one of the FDs that my grandfather had, not even my father, my grandfather had, was a double digit FD. As of today, you pick up any bank, tell me the bank that is able to give you a double digit FD.
Forget about it. They're cutting the FDs left, right, and center. It's going to get.
There is a very it's a huge topic, and there is a very rational reason as to why this FDs, or this is the rate of FDs that cannot be given out. So there is definitely that the capital that used to come in as only FD form. Now you need to understand, Rizwan, that what were the investment avenues available to you even
Not
10 years
much,
ago?
not much that time. Yeah, because that's why.
And you're talking about financial literacy here.
Yeah,
Again, if I go back to financial literacy, what was the financial literacy that probably
very,
people had 10
very
years
low.
or 15 years or 20 years ago? So it is about choices. जितने आपको choices या options will be
Ashwini,
given to you.
sorry to cut in, but people are still putting their money in FDs. Why? Why? That's my big question. Being in the finance industry, tell me why.
Okay, let me give you a very clear example. Rizwan, you're very hungry now. Okay, you're very very hungry. Okay, as
Yeah,
of
I
today,
am. Yes.
you enter the kitchen.
Yeah.
Okay, and what is the very first thing that you'll think of? For example, if you know just how to cook Maggie, your most prominent thing is, I'll pick up my Maggie packet and I will make my Maggie, I'll eat it, I'll be happy. Why did you do that? because you know that, this is, something about, making the Maggie, some knowledge about it, how it works and everything, little bit here and there knowledge. Will you attempt baking a cake altogether, or will you attempt making a pizza altogether, or will you attempt ki nahi aaj to, I will make biryani today? Would you do that?
Good analogy, because I don't know the
You will
B of
not do it.
biryani. I don't know the B of biryani.
You will not do that. If potato ka sabzi is the only sabzi that you know to make as of today, that is a very prominent thing, that I will go and make potato first. The fridge could be full. Mind me, Rizwan, the fridge could be full. But the only feasible thing for me is potatoes.
You're right. You're right. So that
And why? Because here I'm talking about security. I know that, if I make potatoes and if I'm going to eat out of them, I'm going to be at least full.
I'll stay alive for another day.
So people
Okay.
would not want to experiment with their money.
All right.
People
So
are not,
don't you think, Ashwini? Don't you think, Ashwini, that's a fair amount of people in this community who are those Maggie noodles kind of people who are just putting their money in FDs, and or is it also a good idea to keep that also as an instrument apart from your trading and other stocks? Would you think that is also a good way to go about?
I personally am somebody who does not believe in FD.
Okay.
Reason being that, I believe in the philosophy that your money needs to make money. And to be very honest, whatever money that FD makes for me, मतलब उतना तो मेरा खर्चा हो
Exactly.
जाता है महीने का.
Exactly. Exactly. So it's a no-brainer. That it
Yeah, so
doesn't come to
and it's a very risk reward kind of a thing.
right.
Am I not ready to take any risk as of today and yet be a single digit return?
So
Yes,
the
go ahead with it.
same money you can put it on your own investments and make much more than letting it lie around, making nothing on that basis. Is that right?
And that is what I'm saying, that, coming back to financial literacy, do I know that what is it that I can do with that money? Now, like, ideally, bank FDs are taken as securities. For example, if you open a locker today, now, an FD of 50, 60,000 is done, or, 1 lakh is done as a guarantee for that locker. So
Yeah.
when you make FD like that with a purpose and everything, as a security, it's fine. It's absolutely
Okay.
fine.
So as a option for some security that you're putting in,
For some
that's what.
security.
Yeah.
And, okay, and you're at a duration that, what, I am sitting at an amount, at an X amount. I am yet to decide what I'm supposed to be doing about it. I will rather take 3 months or 1 month to understand that, this is the new asset class that I would want to get into. So, okay, fine. I would want to block the money. An alternative to, FDs are liquid funds. So you can, park them in your liquid funds, and then, they are giving you the same return. The liquidity is the same bit of it.
Right.
So, I mean, both ways.
Another question I would like to ask you about is mutual funds. Now, you say people who cannot make biryani, they at least have an option of dal chawal with the mutual fund, don't you think? What's
So
your idea of mutual
let
fund
me let me probably
or
throw
such
light on
instruments?
let me throw light on mutual funds. I think mutual funds work your very primary step to have a financial discipline. So when I say SIP, systematic investment plans, okay, and this is how I have gained my discipline from, then I know every month X amount needs to get into my savings. This is purely, I treated it all this while as a pure discipline. Okay, now this is one kind of people that, what, I do not want to get into any study. I know that, I have to save X amount of money for these many number of years. I'm doing my math, and this is the corpus that I will accumulate. This is one methodology. The underlying assets of a particular mutual fund are equity and debt. So there are equity and debt instruments. So in that, you need to understand that what is it, for example, if I pick up a blue chip mutual fund. Now, when I say, a blue chip mutual fund, it is going to have a large cap or a mega cap kind of a company. So that is what the factor is. If you actually, for example, we're talking about one of the biggest companies in India. If I have to track the equity itself for that particular company, I might make more returns. But if I'm talking about maintaining my discipline, if I know that I cannot have the time or I do not understand the subject, I go by my SIP.
So, that's a good way to go to start off understanding the market.
You need to begin somewhere. You need to
Yeah,
really start
to
understanding numbers somewhere.
yes,
Otherwise, this is absolutely like, if you put me in a chemistry lab today, I would really not know how to actually, do my litmus test and how to, which salt, what to find out. I would not know. Because why? That has not been my area of interest, or that has not been my subject.
yeah.
And which is, of course, it can happen. So might as well that, okay, fine, some saving methodology or some mode of, okay, I'm giving my funds to a fund manager and he will do the management fund. I'm ready to pay the fees and everything for the fund management charges that are there. And I'm making my returns. This is another strategy that you can use.
This fund management charges, many people say that many a times the profits you make in a mutual fund basically don't give you the same returns because your fund management cost or charges turn out to be a substantial amount of whatever profits you make. How do you look at that?
So when I talk about mutual funds can be invested in two different ways. So one, there is a regular methodology and then there is a direct way. So when I say a regular, probably, you go via your relationship manager or through your bank. So, the percentage can go as high as 2.5% also. So that's like your management, the
Please,
fund
yeah,
management charges,
charge.
the 5%. Yeah. So this is a regular way. A lot of companies now and a lot of customers now are understanding that there is also a direct way of investing. So I log into XYZ, for example, I log into an ICICI or an Axis or a Kotak. I log into their direct website and I'm able to do a direct investment into mutual funds for them. There it
Ah,
falls to
okay.
1.5%. Yeah.
Okay, so there are two
So this is
options
this
you
is the
can do
basic
that.
difference.
So there's two
Yeah.
options. Either you go online yourself and log in and buy the mutual funds through the online portal, or you have a specific allocated fund manager for you, which basically increases your cost of managing your
Yeah, I
funds.
mean, it is your distribution charge. So what gets eliminated when you go direct is your distribution charge, your channel partner charges that are eliminated.
Then, as a mutual fund, do I then have to also keep an eye and understand the mutual funds, how is it doing and all that? That would be another process because I don't have a fund manager anymore, right? So that would be all up to me to see that how the funds are doing. I need to understand it and be able to strategize going forward in years or 2 years down the line.
So mutual funds, your minimum, stay put period is nothing less than 12 months or 18 months. So 12 to 18 months is what you need to give that fund. Even when you talk about an equity, a pure equity stock that I'm talking about, you need to give it some time. It's not going to like you put in today, tomorrow it's going to start performing. Then you really have to be very lucky and, very picky about every stock that you pick up. It's making 50%. Then I would want to come to you. So, when you talk about investments, give it some time, give it horizon. This is like actually, putting in a seed,
But in this
let it
case,
shoot up a little.
But in this case, as you said, online buying mutual funds, then you become your own fund manager, right? So
Yes,
you take your decisions annually or 2 yearly or 3 yearly down the line, keeping an eye on the mutual fund, how it's doing. So that also is another way of gaining knowledge and understanding how the markets work, basically. A safe
there
way
are a
to
lot
do.
of websites. There are a lot of websites that are available, which give you a very clear track record as to how a fund is performing, with reference to its peer, or with reference to markets for that matter. So there are a lot of this thing that are there. I mean, in today's world, in today's digital world, you go out there and it's everything is available
Exactly.
like that. Yeah.
Another thing, you must have heard about this insurance-linked investment plans, which
ULIPs.
many, yeah. So, what is your idea about the insurance-linked plans um, in the current situation?
So, just to probably reiterate, so when you talk about life insurances, there are term insurance, which is a pure term
Yes.
insurance, wherein
There are
I
no
am covered.
returns as such here.
Nothing. I'm covered for this particular amount. On my demise, my nominee gets this particular amount. How do ULIPs work is ULIPs have also got their underlying assets and the bonds that they kind of invest into. But ULIPs say you invest in for 5 years, 7 years, 10 years. You accumulate a corpus. That corpus gets available to you for withdrawal from probably from the 11th year. Okay, but in a term insurance, that facility is not there. You can't invest into a pure term insurance, and you would expect कि अच्छा ठीक है मेरा 1 crore का investment it's done. Can I start withdrawing it now? No, that doesn't happen. Okay, but in a ULIP, you have the option that my I have finished the period of payment. I can, and it is an absolute choice. I can have withdrawals in certain duration of years. Like I can have my withdrawal in the 11th year, then in the 15th year, then in the 20th year, and so on and so forth. So this is the basic difference of a ULIP and a term insurance.
Then again, a ULIP linked plan, is it not linked to the market's ups and downs? Basically, it is linked to what we call the NAV, right? NAV. So it
NAV.
could be negative also as you go forward, or positive,
Yes.
right?
So if I have to kind of ask you that question, then what are the underlying assets to for your NAV, or even if you say your mutual funds, when you say that when I buy a mutual fund, I become a unit holder. What is that one unit? What is the underlying asset class, or what are the underlying instruments? Not the asset class, but what are the instruments? So you need to understand that bit of it. So and hence the ripple effect. So your NAVs can be negative. I mean, the fund value, you invest 10 lakh rupees. Why is that 10 lakh rupees going 9.5? A, your charges are deducted. That's one. You'll have your annual maintenance charges that gets deducted, and your transactional fees and everything. So you may lose out another 10-15,000 in that. So you must have given 10 lakh, but the actual investable amount itself is 9 lakh, 80,000. And then if markets do negative, or if there is another incident or a scam that happens, and if that particular fund is stay put invested into it, you'd see further implications.
Right. So
ULIP, I think, because of higher charges, has been a concern.
yeah. So in that case, do you think there is any other insurance plan which is more secured and not linked to the ups and downs in the market condition, that would be safer for people to invest in?
In my opinion, Rizwan, when you talk about a life insurance, okay, in my opinion, and as a discipline, you should keep your investments and insurances very, very separately. So if you really ask me my opinion, as of today, I have a different term insurance. My investments are treated differently. My mutual funds are, are defined with their goals. So because my mutual funds are with a longer horizon. It's a 2-year horizon, or it's for a larger amount, which I can't accumulate. So these are a couple of lakhs that I'm talking about. Now this amount I cannot kind of accumulate immediately in a month or two. It has to be spread out. So that is what my mutual funds do. To create a larger corpus, or to create a larger amount, I have my mutual funds. But my term insurance, in case if something happens to me today, I have financial obligations. So my life insurance is purely for that. But my equity instruments are for my benefits and my monthly returns, or my extra income, or the secondary income. So I'm very clear about my kind of investments that are there. So in my opinion, it's recommended that you keep your investments and you keep your insurances separate.
So you've been doing your own trades online, but you still keep mutual funds. Why is that a big question? Because you know the markets, you know how to deal with your money, and you know how the trends work. You would be a better person to make your money make more for you. Uh, I hope that question doesn't is not sounding absurd. What do you think?
No, not at all, not at all. Like I mentioned, that I'm a working professional myself. now that we are in a lockdown situation, I have some ample time. But if I have back-to-back meetings, or if in my regular day, I used to not get the time to sit and then log in at 9 o'clock, do my trades, and then do the study and everything. That becomes a little difficult. But on the contrary, I need to make my savings. So there is an X amount that needs to go into my savings. And this X amount is something that I will have to save by hook and crook, because I have an expense coming, or I am forecasting an expense in the next 2 to 3 years. Or even if it is not an expense, I just want to do it as a saving bit. So how do I go about it? So that is when I started. And for me, it was very, very important to on the first of every month, that the moment my salary hits, that X amount is deducted, and then I see the remaining balance for my this things. So then
Discipline.
that's my capital. That's my capital.
That's the discipline you have maintained basically, so that you don't
Absolutely.
misuse that money basically. Yeah? Because once you have money in front of you, you don't know what to do about it. You see the latest mobile, you will buy it. That's the trend by people. Yeah.
It is, so even I have realized, and it is an absolute personal experience, irrelevant of whatever money that you're making, you really need to know where it's actually like, it's like water. You really need to know where the water is dripping. वो लीकेज होता है, फिर रस्ट होता है, फिर डैमेज होता है. So you really need to know. And in this, in fact, reminds me of a very, very good friend of mine. And I was very shocked when I looked at this. And he's a Bengali. So he used to come back every day home, and he has a notebook that he's maintained. I think uh, we worked together. So he used to come back home every evening, and he used to maintain a journal. G expense was this expense, this has been the expense. He used to actually write down, even if it is 10, 20 rupees. It's become a habit for him. It's become an absolute habit for him. Now, I'm not saying that, your 5, 10 rupees and all used to kind of, write down. But I think, there needs to be at least an Excel
Discipline.
sheet to tell you where your major expenses are going.
Right.
So even if there is something missing, if there is something that's not happened, or if there is an extra EMI that is gone, or if you have not received a dividend, or if something like that, I think you'll be able to at least backtrack.
And it also gives you an idea of what is the current cost of your maintenance per month and how it is varying as it goes forward. So it also tells you inflationary factors, or what additions you have done to your lifestyle, or what is the difference that it was 6 months ago and what it is now, or what it might be. So it also gives you a fair idea of how you need to optimize your money returns so that you can keep in touch with your inflationary trends in your budget. Am I right?
So I'll give you a very funny analogy here. Okay. You walk into Taj, or you walk into Hyatt, and La Meridian and the big hotels today. When will you be comfortable to order everything and anything that you want to eat, when you have money in your wallet, and when you know exactly that, irrelevant of whatever the amount, I know I can kind of pay it. But imagine the reverse. So what will you order? I mean, you would end up ordering your favorite dish. You'll be eating it and still be very skeptical about the bill that's going to come in. So, you really need to understand that, these kind of, your investments have to be such that, okay, I'm saving for a reason. I'm saving for a purpose, or, I'm saving for my betterment. I would want to retire when I'm 40 or 50. I do not want to stretch it up till 60. I want to be an entrepreneur. I want to be a freelancer. This is not the kind of a life that I would want to have a 9 to 6 job. The agenda, the goals could be very, very different. So I
Right.
think one Excel sheet is needed.
So that is exactly why I think most important is your money management skills before you put in any money into the stock market. I think that is what we really need to explain to the viewers, that you need to start these small activities like daily planners, daily budgeting. That is a one-to-one step forward going to understanding how you can manage your money. Am I right, Ashwini?
It is certainly, it is absolutely, you know, the very, very kind of, right thing. So, yeah, so it's absolutely the right thing. This is about, this is about selling yourself, selling your strategies to yourself that, okay, here I have a product, but, I'm only talking about the product. But then here I have product B with clearly listed feature, with, a proper pamphlet and a proper demonstration. So these are demonstrations that you do it for yourself. When I have written down my goals, when I've written down my strategies, you are just telling yourself that, and you're doing a self-check. You're actually doing a reality check. For example, Rizwan, if I tell you today that I think, in another 5 years, I'm going to make 5 CR. I know it's like I'm going to make 5 CR, and I probably, I might be in a position to buy, a Phantom, a Rolls-Royce Phantom. Now, sounds great, but what is your, when you talk about smart goals, is it realistic? Is it a very realistic thing? It can be real. It can be real, but can you at least prove it on paper? At least prove it to yourself on paper. At least prove it to yourself in front of you. So I think when that strategy and when that mindset and everything has been there, then you're half. It's like it's a half battle won.
So no goal is impossible if you have already put in the right plan in place and you have done the reverse engineering and broken it down to smaller and more practical and realistic processes on a day-to-day basis. Am I right?
So, Rizwan, I remember a quote, and I can, in bits and pieces remember it, but it's very, very close, and I follow it immensely. So, a goal without a deadline is just a wish. I repeat, a goal without a deadline is just a wish. And you can have a lot of wishes, but then there has to be timelines, and these timelines are for yourself. And these timelines are for these are your milestones. You cannot you cannot reach an age of 59 and then start planning for your retirement.
Right.
And no, that's not going to be really sensible. That is when I talk about, when I specifically said financial literacy. I'm not talking about literacy. I'm not talking about reading and writing and being able to sign your name. I'm here talking about financial literacy. How many people that you go out there today, or the viewers today, know exactly the amount that I would want to retire with?
You're right. Not
So
many
you're
people.
running around like a headless chicken. People can be self-sufficient. If I am 60 today, for me to probably survive for the years to come, if I make a 2 crore, I am more than happy. Now in that 2 crore, I am 60, I don't have the mental ability, and now I'm going to put it in an FD and earn a 5% return.
That's too late.
Which is still very sufficient for me. Another 2 crore, if I've had, I'm going to put it in my FD, and I'm going to make returns out of it, because now I have dusted enough.
Right.
I don't want to make any load. That's when my FDs will come into picture.
But again, a very good thought here that many people at the end of their age limits, they start thinking about what we have to do later when they're retired. Don't you think that's too far too late? Because then you don't have the kind of income to be generated to give you the returns going forward in your retirement, because then you have to just depend on your FDs, and the FDs after some time they actually are not able to beat the inflation. So it zeroes out. Don't you think that is the way?
So if you are aware of the SIP amount that goes in, it's as minimum as 500 rupees per month.
Mm.
That is the minimum that you're talking about. And if you're talking about somebody who's making 15,000, 20,000, 500 rupees is what he has to manage every month. And then these mutual funds are growing at a CAGR return. So the power of compounding, which is a very beautiful subject. Okay, the power of compounding, because all these things are, on compound interest, and it's humongous. We are not running on simple interest here. My 100 rupees is not going to become 110. It's going to become 121. So that needs to kind of, really
Exponentially
fall
growing.
in place for us. And, it's exponentially growing. And, 1x, 2x, 10x, you
Yes.
really don't know.
Yes. It's like the
That is,
chessboard.
I think, the
It's a,
reason.
it's like the chessboard with one grain on each board and multiplying it. You don't know
It
how
is,
much you're going.
and you really need to start early. I mean, one of the way, of course, is to start early. But the real fact remains. But it is never too late to at least start something. And and going back to the ideology. Do you even is your primary income taking care of everything possible? Then I think you really kind of you've arrived in life, I would say. But
Then
as
even that, Ashwini, even if your primary income is taking care of everything, you cannot totally depend on your primary income because it's so unpredictable, right? You don't know what's going to happen tomorrow or 2 years down the line. So you need to have a passive source of income any which way. Am I right? I would like
talking about markets, so in panic situation, the markets are definitely volatile, and the GDP numbers are at negative 23%. So you need to understand the impact that we are going through. So these cycles, the time of these cycles are bound to reduce. And when I say markets are unpredictable, uh, you take the legends of legends, and the answer would remain, or the statement would remain the same. That markets are unpredictable, but there are cycles. Yeah, and if you really study, like I have a lecture that there. The cycle short. If you see, over getting started. So either you treat it as an opportunity or you treat it as a crisis. All sectors are not going to perform like waste. So in COVID, the outperforming sectors, of course, were telecom and pharma, of course, being the reason that why the pharma perform. And then you've seen stocks like Vodafone and Bharti who have picked up.
some result to the that could be pent up demand for the last so many months or years. Would that not be another way of looking at it?
Couple of factors. I'm a little less knowledgeable on that factor because automobile is not my
Yeah.
no,
Okay.
it's not my
Supporting,
interest.
yeah. Okay. So that was one of the questions which came up. Let me also look at another question. What is the difference between intraday trading and gap trading?
Oh, very beautiful. Intraday. So going by the terminology, intra and day, buying and selling needs to happen on the same day. Okay. So your settlement, the square off, if I have to say, it has to happen on the same day. I can buy something and then sell, or I can short something and then buy later. So both these activities have to happen on the same day, and that is why it is called as intra-trading. When I talk about gap trading, for example, that Nifty had closed on Friday at 11,500, but on Monday it opened at 12,000. So a gap trader will actually see a 500 gap. Now, as a philosophy, these gaps have to be covered. So when you see, and this is a very technical thing, I'm just simplifying it. So a gap trader will actually see the opportunity that, in probably 1 week or, 15 days, this gap he is very, very sure will be covered. So that's what a gap trader. He'll identify that, what are the gaps, how much is the difference, or,
Add it all together and,
he'll
value
find
it.
opportunity. So gap
Yes.
trader is nothing but somebody who's going to find opportunity in
So
that
that
gap.
is also a strategy, basically. Gap trading.
It is, yeah. It's one of the trading strategies that are there.
Okay, right. Another question is, what is an average return one should expect from equities and from option trading?
Oh, okay. What is an average return? Coming back to the question, what's your horizon? If your horizon is 1 month, and you have invested in a large cap or a mega cap kind of a fund, that has made even 5%. If you're saying the same large cap or the mega cap fund for 4 months, it has made 100%. So what is the horizon that you're talking about? And this is a very open-ended question, to be very honest.
Option trading and normal equity trading is something different, I think, right? When we talk about the trading styles.
When I talk about equities, equities are the actual script that gets traded. But when I talk about futures and options, they are called as derivatives. So derived from that. That's what futures and options are.
But then it's a lot of it's also a lot of leverage on option, right? You need to be very careful how you deal in the options market.
I think it's for pro. I'm yet to be there. Yeah.
Okay, so you don't deal in the option.
So in my opinion, for a beginner, this is how the beginner would. This is how I began. You probably start with mutual funds. You get onto equity. You get onto futures and options. Then you get onto probably commodities. Then you get onto currency, which is foreign exchange. So considering the maturity and probably index trading and things like that. So this is probably so if somebody is telling me that I deal in futures and options and I deal into currency, I think guru, very high regards.
Really. Because FNO is really a lot of in-depth research you need to do.
It's a very disciplined market. It's a much more disciplined. It's a much more number-driven market than an equity. Less speculations, in my opinion.
Foreign exchange, I think, is the most volatile, you would say, because it's so unpredictable. It keeps on moving by the minute, and you need to be really very.
It's two different currencies, and I don't have a great math. I can't buy here, calculate my return, then the brokerage. No, not happening. I told you, right? Very feeble heart.
Okay. So you are basically focused on equity, and you really put in all your study and research.
You mentioned about provident funds. I'm in funds. I think the corpus people have made is humongous. Okay. And probably the best that we have in the country is provident funds, and considering the returns and everything. That is one. Considering that, when you talk about mutual funds, you know that you are being able to accumulate X amount of corpus. So basically, if I have to talk about a percentage, 10% of your salary goes into your savings. This is absolute, this is like, this is clear mathematics that we're talking about. I make a lakh per month, 10%, which is 10,000 is my minimum, is my minimum that has to go in as an investment. So even if, I am a person who does not understand anything, but I know that, saving is supposed to be a parameter for me, I should begin with 10%. Okay. Mutual funds have an option to increase your fund allocation by 1,000 rupees or 500 rupees or by a certain percentage every year. Any mutual funds that you kind of, invest, if you've given it a 3-year horizon, it has definitely made returns for you. But you need to understand that, it's like, it's your money. That money, at least, once a year or, half yearly, needs to be reviewed. So that is something that cannot be, it's just like, you need to water your plant. You need to keep checking if there are weeds around and it has to be replanted here or there. So that, of course, needs to be a check. And once a year. And this is, again, I'm talking about mutual funds. Needs to be done at least once a year. When I do that, when I do my rebalancer, when I do my check, I need to know that, okay, this fund is not performing that great. Can I stop investing in this fund and can I, look out for other fund? This is one idea that you get. Or this fund has performed its maximum. I think it's time to withdraw it. So for some of your, midterm goals could be taken care of in that point of time. So mutual funds work very hassle-free for you in creating that corpus as a second point of time. Now, when I talk about equity, and you're somebody that who has the corpus, who would want to get into equity, but who does not want or does not have the time and knowledge, there are something called as the PMS houses, which is called as the portfolio management houses or services that you talk about. That that you give them 25 lakh, 50 lakh is the amount, and then they give you a guarantee return of 12%, 15%, 18%, depending upon how the fund is performing, and they directly invest into equities. So these are called as portfolio management services, or wealth managers if you have. Yeah. So when these services come into play, you pay them a fee. You pay them a fixed 1%, 2%, 2.5% kind of a fee, and you're making your returns. So you know that I've invested. I would want to explore equity. I don't have the knowledge or time for it, but this is a corpus that is lying with me. I take help of services that are available like this.
All right, that's
So this is one option that you could do.
Okay, so could you give some examples of such portfolio all across such investment?
Most of the banks have got their portfolio services, or if I have to say the PMSs are. There is something called as a pmsbazaar.com.
Okay.
And this is something that I refer to. So you could probably visit there. So just to name a few, there is Alchemy, ASK, Motilal has its own, IFL has its own PMS. Then there is Marcellus, as a new add-on that are there. So lot of PMS houses.
Okay.
So
Nisha, sorry. Nisha wanted to ask a question. Nisha?
Just 1 second, Rizwan.
Yeah, please.
If you just want to do your research, so 2 categories, PMS, which is the ticket size for it is 50 lakh. Then there is an AIF, which is the investment ticket amount is 1 CR. So if you know that this is the kind of a corpus that you're there. Additionally, if you know that that is not the corpus that I'm having, or that's not the amount that I'm having, there are private wealth managers or certified investment advisors, which is called as IEF, investment advisors that are there, certified investment advisors who have who can give you these investment options, and then they do the rebalancing, and then they take care of your product. So you can either go to an advisor or you could go to a wealth manager.
All right, thank you so much.
You're welcome.
Great.
Yes, Rizwan.
Yes, Nisha. Nisha, you would like to ask a question?
Yes. Yeah. Hi, Ashwini. It was really great, listening to you. I have a question, like, as you suggested, the Maggi noodle and the biryani part of it. So, like, do you feel do you have a success mantra of something? Like, how do you develop a risk appetite? This is what I want to know. Like, because for me, it has always been like, the moment I decided to enter markets or something, I do enter, I take a plunge. And then I feel, no, it's, I'm not game for it or something. And I can't stay around there. So what would you suggest?
Great. I think if I have to go back to the analogy for Maggi. Now, today you're hungry. You have half an hour. So you make Maggi. You know that, this is going to be the same situation next week. I think what you would be doing, at least you would, pull out the next the next easy recipes. So probably you would do a little more reading, and then probably you would go on to making Maggi with cheese and Maggi with vegetables. Eventually, you would switch on to probably dal chawal and khichdi, and so on and so forth. So what I'm trying to tell here is that because you've taken a hit and because the subject knowledge was not there, it has put you back in your box. So the very first attempt, is to go back, and probably if you've lost X amount, please treat that amount as the the fee that you've paid to the market to understand this subject. And when you start treating it as a fee but not your loss, it gives you the courage to go back and study further. So I think my recommendation is the very first thing, you just go on the NSE website or the BSE website. Just navigate through the website. There will be something, probably a graph or a company or a news. Just pick up something or the other that have an app on your phone. Have an app installed on your phone, which keeps giving you that news and getting you in the groove. So I have also faltered. I have also, if I have to really quote, I've lost a couple of thousands in a day. It's gone absolutely negative, and to recover that. I took 1.5 to 2 months, but had I given up on that X amount, that would have stayed with me forever.
Okay.
So I think the only thing is to probably go back and study.
Just a quick another question, if I'm permitted to do so. Am I okay?
Yeah,
Sure.
Nisha.
Yeah, as you suggested, there is a phase, moving from mutual funds and then move on to equity and then so on. All right. So like for how long would you, like, as I asked you, for the risk appetite, say now I have also started with my mutual funds, but how much time would you advise me to kind of stay on this mutual fund thing and learn and then move ahead to equities? Would that help me in kind of, learn to take up risk, or should I go for these PMS or these wealth managers? What do you suggest?
I think you need to test waters first, and it's a different level of confidence when you know about your own money, because this gives you a sense of independentness, and this gives you a sense of awareness, if I have to say, more than independentness. So when you know about your product, when you know about your funds, you're not blindfoldedly going by anyone's suggestions or anyone's recommendation. You are deriving your own rationals behind it. So, if you know that, okay, mutual funds is what I've invested into, then I have gone on to equity because I understand that, for mutual funds, my underlying assets are equity. So if my equity, for example, my ABC equity performs brilliant, my mutual fund is bound to perform brilliant. So you're at least in a position to derive that rationale. Rather than somebody saying that, what, madam, I think, this is, a great company. These are the returns over the past and everything that is there. I think the only thing you'll have to say is or a yes or a no. But, you're still there. There's always a gray area. There's always, what is the rationale? What is the rationale of this investment? And again, like I said, if that is not your agenda, if you know that, this is not my agenda or this is not my priority, I have a liquid amount just lying there, me not knowing what to do, might as well hire somebody and let that, pay the fee and do it for you.
Okay.
That is also one of the options that's there.
Okay. Yeah. Thank you so much, Ashwini. Yeah.
Anyone else? Yogesh, would you like to ask some question here? Right. Another question you just mentioned, Ashwini, which related to Sanjeev's question. You said there are independent fund managers where you don't need to have a 50 lakh corpus or a 1 crore corpus. So when you say they are certified fund managers,
Financial planners, yeah.
Financial planners, okay. So what minimum corpus do they work from?
So it really depends. Like, it could be 10 lakh, it could be 5 lakh. So it really depends on the advisor or the kind of sub broker that you would probably want to deal with. This is purely on relationship and purely on how it works. But just a word of caution. A lot of promises, that are being made, and that is why I am reiterating. It is always better to it's about jumping into water. You should know how deep those waters are. You do a deep dive and you know that the depth of the water isn't so much. You're going to hit rocks and you're going to be injured. So you really need to kind of know the depth of what you're getting into. And the basic understanding, again coming back to financial literacy, is that if my investment advisor is telling me that this is the kind of returns that I am guaranteeing you, what are the instruments or what are the underlying assets that you would want to get into, or what is it, what is the ratio, what is the debt equity cash ratio that he's planning to. So when these things come out, the person cannot actually fool you also, because I think financial instruments are one of the most missold instruments, so, and it's your hard-earned money. You don't want to go wrong in it.
Yeah, another question, Ashwini. Today, when the global scenario is so down, there is negativity all around. But even then, people are investing in the stock market, and they seem to be in a much more euphoria to invest than what they were earlier before the pandemic struck. So, what do you think is the reason for it? It seems to be totally contradictory to what it should be as far as the unpredictability of the global scenario is concerned, in such cases, people tend to be staying away from the market. So what is the reason that there's so much euphoria about this stock market?
See, again, this is about capitalizing on the opportunity. And like I was mentioning earlier, if somebody has invested in the month of April this year and has seen the rally, please do not, have a misconception that this has been your study and your choice. The markets have rallied, irrelevant of whatever that you've put in. It has to rally. Some have made 50%, some have made 10%, some have made 110% also. So whatever that you invested from 7,500 to till present, the stocks definitely have rallied. So assuming that, you know what, I think I've become an investor and then this is my forte and this is my subject, I think this one data point is, so it's a very technical thing. Let me kind of, tell you. How many points do you need, Rizwan, to make a circle? Are you aware?
Infinite.
No. You need 3 points to make a circle. So a circle is actually derived from a triangle. So if I have my 3 points of a triangle, my circle is drawn.
The circle in between, yeah, okay.
Yeah, I'm talking about like an equidistance triangle. I need 3 points. Similarly, in the same analogy, I'm talking about trend lines. If I have to predict a trend, I need to have 3 points on a trend line to define that this is my trend. Now, this could be a major trend or a minor trend, but 3 prominent touching points that I need to define that actually this is an upward trend, this is a downward trend. What is a trend? I need to understand. So when I'm able to derive that 3 points, and again, a trend ka time, you really cannot confine on the trend time. A trend could be, for 3 months. Okay, for the next, for the past 4 months, it has been an uptrend for one stock, but it is not the same for, stock B. So everybody who's invested in April this year has made money. The point is you need to have at least 3 instances or 3 data points or, 3 validation points that, what my strategy is, time tested, backtracked. That is when I think, one can be in a position to say that, what this strategy works.
You mean to say not everyone is doing that? Many of them are playing on emotions, basically jumping into the market with an opportunity, because most of the market stocks are down and they think that anyway going is going to be up. Is that what they predict? Basically?
In my opinion, I think what has happened and what has kind of, come across is the markets kept falling from March till I think, somewhere till mid of April also, and recovering in May. So there was a lot of people were at home. It was a lockdown situation. A lot of, so they actually had the time to pay attention to something that they must have just, read here and there. So in that period, a lot of time was given. And if I have to share about statistics, 3 lakh demat accounts.
Exactly, that's what I'm talking about.
Since that particular point of time. And this is, from the, this is from SEBI that I'm talking about. Now you're understanding. It is a security for you. So you get, please mark my, and house is never an asset unless and until it is a house that you're not staying in. It's never an asset. It's always a liability for you. So, because you're paying your EMIs and all that. If you're talking about buying a second house and, you're buying it with an intent of probably rentals, you need to understand the kind of yields, the rental yields that are happening as of today. In a city like Bombay, which, is amongst or used to be among the highest rental yields, from double digit, I think it's fallen to single digit. So when I talk about rental yield is I have a 50 lakh property. What is that or what is the rent that particular property is making for me every annum or every month? So when you calculate that, you'll actually, figure out, you'll actually derive at a percentage, which is called as your rental yield. And into the number of years will of course tell you that, what my 50 lakh property, gave me a return in so many years with my rental yield. So the rental yield itself has fallen to a single digit. Whereas your equities at any given point of time with good research and everything will give you a double digit return. Even if you are a swing trader, if you end up picking the right stock, if you end up picking, doing your right technicals, you will make nothing less than 5%. And a rental yield is somewhere for Bombay, if the last I read was last year, was hovering around 2 to 3%. And again, the question comes on liquidity. How easy can it be liquid? Selling a house versus selling your equities, which is more liquid? So I mean, these are the things. Yeah.
And second question was, how about how to read the charts?
How to read the charts?
The graph or the chart, daily chart, or how is, I mean, because I hear a lot, many analysts saying, you read the chart, and you also said, you read the chart and you know the trend of the business, of the stock.
Okay. Let me give you a very simple, in a very humorous way. I think you need to start appreciating paintings, Yogesh. You need to start appreciating art, and that's when you find the graphs very, very colorful. So they're like musical notes. It's just that they have their own prices. But again, on a serious note, when you talk about charts, there are different kind of chart types, if I have to say. So there are bar charts, there are candlesticks, and there are Ekenashi and a lot of other things. So when you talk about a basic bar chart, it'll have an open, close, high, and a low. So this is one bar or one candlestick. What I did initially when I was learning about candlesticks is I just made a little printout about what are the different kind of candlesticks, and I stuck it in front of my work desk. When you see them repetitively, you understand. And these are purely what do you say, normal charts, normal data interpretation charts that you've seen. If you see a bar graph, if you see the bar growing, it's an uptrend. It's an increased sales. When it is diminishing, it is a downtrend. So it is not very difficult to read a chart, and it's not very difficult to read a graph. The very starting point for you will be, can I pick probably a bar chart, and can I say, okay, this is the high, this is the low, and this is the close, open, or whatever. I have identified that. My second step is I need to identify what is the trend. Is it an uptrend or a downtrend? So when you're able to at least get these two things starting, the rest will fall in place for you, in my opinion.
Thank you so much for that.
Sanjeev, you wanted to ask something? Sanjeev?
Yeah. Okay. Well, I've already complimented Ashwini for a really very great insight into stock market. She's as clear as ever shining. Training concepts also. In fact, to be very honest, I mean, I was just sitting with a friend and this webinar when this was happening, and he happens to be the executive vice president of ICICI, and he was just hearing her, and he just complimented. In fact, we were hearing, and I said she's a classmate, and she's doing the program and all that. So she just wanted to compliment, put some points across. If it is permissible, a very good friend sitting next to me, and though Ashwini and these finance matters are best known to these people, but if can I just allow to introduce Ashwini to him, and if it is permissible, he's just right across to me. He's Raghavendra Pandey. He's the executive vice president with ICICI Securities, and known to me for the last 25 years. Just traveling by, and
definitely, Sanjeev, please.
He asked me this question: who is this? So I was just explaining that Ashwini is into. So I will just hand over in case it is okay.
Yeah, please, Sanjeev.
Yeah, over to Raghavendra.
Hi guys.
Hi, good afternoon.
Yeah, Raghav is my name, and I guess the latest one can connect with me is I did the Future Reliance deal.
Okay.
Oh, an absolute honor.
Sorry, thank you. So that was the last or maybe after that, couple of more deals on the Reliance Jio side, roughly around $6 billion was individually done by me on the Jio side, and we are closing another maybe $3 billion deal. So I'm primarily an investment banker, and I work with ICICI Securities as of now, and executive vice president. Primarily looking after conglomerates and so all the top 50 companies in the country. I was hearing you. Good, great. I can only leave the entire group with one more perspective than the perspective which is very educative, which you shared. I got into the stock market in class 8.
Okay. In school.
Yeah. So I didn't know what I'm a science student, obviously a management graduate later on in life. But at that point in time, a good physics, chemistry, math student, had nothing to do with commerce, had no understanding of balance sheets and profit and loss account. I have a very, very successful stint, and this was roughly 32 years back. So successful stint primarily on the stock market investment front, and unfortunately I have been able to touch a mutual fund because I feel, and I work with all the CIOs of mutual fund, but I feel that their thesis is a little different than what an investor wants. But so I wanted to only leave one larger perspective of investment. I didn't know what is a balance sheet. I didn't know what is a PE multiple, and all these questions you all were asking. If I take myself back to class 8, and my philosophy of investing, whenever I have deviated from what I had in class 8, I have lost money. All these bar graph charts, this, that, global analysis, GDPs, liquidity, Fed. So, well, these are part of my business today. But the philosophy was very simple. And I would ask the same thing to the group. Is ki biscuit kaun sa khate ho?
Yeah. What are you using in your day-to-day?
So what can you touch? What can you feel? What can you see? Is the first place to invest. If in this entire group, I don't know who would come and tell me, how many would have a different answer than biscuit to Britannia ka khate hain. So Britannia mein invest karo na. Now you will have all kinds of experts coming and saying this is expensive, that is expensive. Let me tell you, I have a global experience of 20 years. I've not met a single guy on this planet who can explain valuations to me and PE multiples to me. If Britannia is trading at 3,800 today, Britannia was trading at 700 rupees 7 years back. It went to 6,000. There was a split. Whether Britannia will be 3,800 to 7,600 or 10,000, and this PE multiple of 60 or 70 or 100 is high. All this is in this country. Britannia sells. Britannia will sell. You can review when can come somebody come and say that Britannia doesn't sell. So या तो आप पार्ले का बिस्किट खाते हो या ब्रिटानिया का खाते हो. पार्ले लिस्टेड नहीं है तो ब्रिटानिया का शेयर्स खरीदना चाहिए. 3,800 रुपीस महंगा है तो एक काम करो, पिछले 20 साल के जितने चार्ट्स देखने हैं देख लो कि ब्रिटानिया ने कैगर में क्या रिटर्न दिया. That is one.
And whether you will be able to buy it tomorrow at the same rate or not, yeah?
You will never be.
Exactly.
I can bet on this. You will never be. So simple. Paint घर में करते हो तो कौन सी कंपनी का पेंट लगाते हो? I have not heard anybody saying except from Asian Paints anything. ठीक है. तो Asian Paints क्यों नहीं खरीदते? विजय सेल्स में जाते हो या फिर कहीं भी क्रोमा में जाते हो, you buy anything of the electronics. Who runs to you for getting it financed? Bajaj Finance.
Yes.
तो Bajaj Finance क्यों नहीं खरीदते? So my investment understanding, learning has been very simple, clear. What you can, the first principle, touch, feel, consume, understand, buy it. The second, which one could develop over a period of time, is the company which are non-financial. It's a consumer-led country. It's a consumption-led country. It's a huge country of consumption. So consumption stocks will do well. Keeping the first principle in mind intact. And the third is companies with high corporate governance, low debt, good runners, good promoters are the companies that do it. So this is the summation of my entire learning of 32 years, let me tell you. I don't need to go one line beyond this.
Great. Great.
Yeah. Very simple at this point in time. What will do well? Market leaders will do well. We all know sometime the markets will open. Now, whether it opens on 1st of October or 1st of December or 1st of February, one doesn't know. But सिनेमा तो आइनॉक्स और पीवीआर में ही देखने जाते हो ना, पीवीआर खरीदो ना, राइट? बाहर जाओगे तो वीआईपी का ही बैग लेके जाओगे, तो वीआईपी खरीदो ना. And yeah, so that's the only thing which I would wanted to leave the group behind with in terms of understanding. Rest, obviously, she is a pretty talented, and I heard her views across and the way she actually navigated the entire conversation.
Sir, one question. Now that you're on the webinar, I hope I can ask you one question. We are
you can ask me as many questions.
No, we are recording this webinar right now. So I need your permission. Would you allow me to put it on YouTube, or do you want your comments and your discussions to be edited, or would you like me to put it as?
No, I'm absolutely fine. There's no reason.
Because I don't want to, contradict or go against your corporate policies or procedures. So it's very important for me to know about that. Right?
So you can put it, but obviously since this is not something official which I am on.
Yeah. Okay. Sir, another thing that we are looking at right now is the banking NPA situation that we are all very concerned about, because there's a lot of things being talked about the banking sector not being liquid and a crisis coming up and all that. So that is something we all as individuals are very concerned about, as far as which bank we need to keep our money in, or how secure is our money. That's something which we are all thinking about.
So important thing to understand is that all banks, the top 5, top 10, whatever, in terms of liquidity, NPA challenges, or whatever you say, you need to look at basically the way, the generation which we come from. We categorize in 2 categories: PSUs as well as privates. Now, whether you keep your money in SBI or whether you keep your money in SDFC or ICICI or anybody, the liability of Reserve Bank of India is the same.
5 lakh.
Right. So the question is whether you put it in SBI or put it in ICICI Bank, you'll get the same amount. Now, what you'll see, I don't know if you all may not be watching it so closely, but all the good private banks have raised money in the last 3 months. Because the situation of NPA will be only clear as on 31st of August or 30th September, right? Or it will also gradually unfold. It's not, people have their moratoriums in place, people have their... So what can a bank do? A bank can only fortify it with more capital, more equity to take care of the demand, right? So I also happened to raise money for all of them in the last couple of months. So we raised 10,000 crores for Axis, 15,000 crores for HDFC, 15,000 crores for ICICI Bank. So all this is capital, equity capital, which has been raised to ensure that NPAs don't create a challenge. So I don't see in the current scenario anything is a challenge. So all the top 5, 6 banks are a very safe place to keep your money.
Thank you very much. So that
doesn't mean the smaller banks are not safe. The smaller banks are also safe. RBL will always also be raising money. Kotak raised money to the extent of 7,000 crores roughly. So I believe everything is safe. Apart from that, the only challenge in this country, if you ask me, is the cooperative banks. And educated people don't normally go to cooperative banks. It is the people who are not able to open their accounts for some reason or the other, are the people who go to cooperative banks. That's my feeling is, and they're more driven by political parties and others.
Another thing, sir, we are also looking at the global scenario being the economic downturn. So many people are saying that when the global scenario is such, India stands in a very strong position because all other countries would like to bring their funds to a country where there are growth prospects as far as numbers are concerned. As you said, the population of India and the consumption level of India is much, much higher than many of the other countries. So, don't you think that could be the long run positive scenario that India stands at as far as the global economic scenario is concerned?
This is not something which is a very isolated question, as you and I would not agree that India will do much better than others. I can only say, if you look at the last 8 quarters, our GDP has been slipping. It's nothing to do with COVID. So a scenario emerges based on the policy from the policymaker and governance from the regulator. So at this point of time, a country with high consumption can allow you to sell a lot of Lays in the country. Okay. At the same time, opportunities are high. For sure, opportunities are high in this country, which means people can and are willing to pour in money in this country because they expect that the returns can be much higher than global returns. And the moment you hear a higher return, it means the risk has to be had for somebody to offer a higher return. Right? It's very simple. When Yes Bank says that my savings account interest rate is 6%, I'm just giving you an example.
Yeah. Big
If somebody
question
says my interest rate is 2%, I would rather put my money there because the high return means, obviously a high risk. So India certainly is a developing country since I started studying, until now it is a developing country, and I think it will remain a developing country. What we have been able to develop is a very, very strong internal framework and large HNI's capital in the country. We are doing almost one IPO every week from the last couple of weeks. The first IPO during this pandemic time we did was a company called Rosary Biotech. It was 80 times oversubscribed. I think it was a 500 crore IPO. We closed an IPO last week, which was Happiest Mind. 150 times oversubscribed. Ashok Khuta was the promoter, the guy who did Mindtree also, which was bought over by L&T and all that. So the amount of money flowing into the country is amazing. That global investors are coming in. So roughly we have raised some 66% money coming into the country. And personally at my level, I'll do roughly 1 lakh crore of M&A this year. Okay. So money is certainly coming into the country. And because the return in this country is expected to be much higher than others. Yeah. But that doesn't mean that, it's also a factor of interest rates and the global liquidity which is chasing it at this point in time. Interest rate scenario can change, US elections can change it, India-China disruptions can change it. And a large amount of capital is what government needs to also raise, which can also disturb the entire challenge, problem, because, the government itself needs money right now to function. Whether one can sell BPCL or one can do an LIC IPO, government is also fumbling. I'm doing a 10,000 crore fundraise for Power Grid. So we are at a cusp where one cannot be very, very easy. I don't see the next 45 days to 90 days going to be very, very easy. And that's the reason the pressure in the market is shown, I think.
But the US dollar currency situation right now being dollar being so weak, don't you think that the FIIs are looking at opportunities elsewhere where they can park their money, and India looks a better deal as far as you rightly said, returns are concerned?
I agree, but I'm saying it's not only the function of rupee dollar parity. It's a function of interest rate parity. It's a function of other tensions. So there are a lot of factors which come in. Examples. So in fact, she was answering a question on housing versus equity. I would add one point because again, I'm saying this is just perspectives. When you are investing in a house, 80% of the money is bank's money.
Yeah.
Okay.
Loan.
When you're investing in equity, 100% of your money is your own money. So let's assume you bought a 1 crore house, right? And it became 1 crore 10 lakhs in 1 year. So your investment was 20 lakhs on which you made 10 lakhs. Out of the 10 lakhs, you took a 80 lakhs loan. So you paid an interest rate of say 8%, 6.4 lakhs back. So you made 3.6 lakhs. You made 3.6 lakhs on 20 lakhs. Right? So the return is very, very high. So that is also one perspective when you are investing in a house versus, because the money which you are putting in the equity, you might put 20 lakhs and it gives you a 5% return. And let me tell you, all can be wiped off also.
Certainly, yeah.
So Satyam compute in the drains in single day. So I'm saying when one considers housing versus stocks, and as she was likely also saying, that there should be a right moderate average, whatever the way you think your investment should be in terms of risk average. A good amount of allocation in all portfolios.
Thank you very much, sir. It was your voice.
You can copy others.
Your voice is breaking up, sir.
Okay, no, I'm saying you can call me Raghav rather than Sir.
So Sanjeev, it was a pleasure to talk to your friend, and it was so much information that we got today. Ashwini, would you like to also make some points or comments about the discussion we just had?
No, I think, see, he's an absolute guru. So I think this is all incoming information. I don't think so I'm in a position to give any outgoing information now. But whatever little I practice and whatever little being shared, I think at least that was helpful to begin with. I've been a beginner myself. It's a very, very long journey ahead. So yeah, I think absolute honor, sir, to have heard from you.
All the best.
Raghav, great. Thank you very much, Raghav, for you have actually helped us in this webinar, given your very important and very valuable insights of how the banking system and how the economy is working right now. Thank you very much, Raghav. And thank you everyone for participating in this webinar, especially Yogesh, Sanjeev, Nisha, and last but not the least, Ashwini, for giving your valuable time and your insights and your perspective about the stock market and trading industry. So from all the participants here today, I would like to thank Ashwini for being here on the webinar and enlightening us. Yes.
I also compliment you. Let me compliment our dear Rizwan Dadan for being an excellent and outstanding moderator. I think I'm personally very impressed with the questions you asked. the way you moderated this entire discussion. So compliments. It was only because of your moderation and the right questions that it steered so well.
Thank you very much, Sanjeev. Thank you.
I'm again, I hope by introducing a small element, since my friend was sitting next, I hope I have not, offended or
No.
I hope.
Not at all.
I hope
You
Absolutely
have
not.
actually given us more enlightenment about the banking industry through Raghav and his involvement. So thank you very much.
The idea was just to make sure that this discussion is more fruitful. It gets some merit and more merit. And thank you so much.
Thank you, Sanjeev. Thank you, Nisha. Thank you, Yogesh. And Ashwini.
Thanks everyone.
So,
Thank you so much,
all
everyone.
of you, all the best. Catch you later. Take care. Bye bye.
Thank you.
Thank
Bye bye.
you.
Yeah.
Bye.
Bye, Ashwini. Thanks.